How many stocks? No more than 10. No less than 5. You can't be diversified with less than 5. But remember that you must do 1 hour of homework per week per stock. Give it to someone else if you can. And you can't do more than 10 hours of homework a week either, unless you got a lot of free time on your hands. I don't want you to be a mutual fund. Here's my top 10 list for how to pick stocks for a discretionary portfolio. And again, I'm repeating, the key here is diversification. Do you have your paper and pencil ready? First, you want to pick a stock from your neighborhood.
House of pleasure.
A local name that you can check up on. A company you really know or relate to. It doesn't have to be headquartered in your hometown, but make sure it employs some people close to you so you can talk to the workers around town or read about it in your local paper. By the way, local papers are your secret weapon. Hardly anybody on Wall Street reads them, even though we've got the web and you can. This gives you a stock edge. You have the local knowledge that the big money guys in Lower Manhattan or Greenwich, Connecticut just aren't keyed into. Second, you want to buy the stock of a defensive, recession-resistant, secular growth company. A company where the earnings will be consistent, even when the economy stinks. Can't think of one? Why don't you go to your fridge? That's empty. Go to the supermarket. How about the local pharmacy? How about your medicine chest? Find some classic soft goods stocks. I'll just give you 2 examples, not necessarily these are the right ones. Procter & Gamble, Kellogg. These stocks are your insurance against the economy going south. If the economy's already gone south, you should buy more shares of your recession-resistant stock relative to other stocks in your portfolio because these do well when the economy isn't doing well. The economy? Recession-resistant? Third, to be diversified, you need a high-quality cyclical stock to balance out the defensive secular growth stock you just picked. The best time to buy these stocks is when they've been beaten down and become what I call accidental high yielders. Industrial companies, they hardly ever try to pay big dividends because they know the business is lumpy, and if times get caught, they're going to have to cut the dividend, which is something they're loath to do. But sometimes their stocks get so hard hit that even a small dividend turns into a big, and what's big, 4% plus yield. That's the best time to buy an industrial if you have the opportunity. Fourth, if you haven't picked up one already, you need a high-quality brand name stock with a nice, notoriously BIG, juicy dividend yield. Your portfolio should have at least one high yielder. More is better. Now, what counts as a high yield depends on the strength of the market, but here I mean something with a safe dividend above 4%. These, again, just to give examples, not to say these are the ones to buy. I'm thinking about Verizon or AT&T with yields at that level or higher. And if they are way, running big up, no, find some others, okay? Something along those lines. Fifth, I know it seems toxic at all times and has been for a very long time, but you should own One Financial. If your local bank is a good one, nice place to start. What you're really looking for is something with a good balance sheet that's not weighed down by a lot of toxic assets and has the ability to acquire other banks. 6, and I'm the only person who will tell you this for certain, make sure you own something speculative, a risky stock, something that's trading maybe even in the single digits, but that you think could be a winner. Now, when the market stinks, good small cap stocks are harder and harder to find. So if you don't feel the need to speculate, this is something you might want to forgo at certain times. 7th, I think you should own a retailer. Different markets call for different kind of retail plays. When the economy's awful, you can still find decent retailers. They're usually beaten up. Maybe the trade down names, places where people shop more when they get poorer, like dollar stores. In better times, try to find a younger retailer that hasn't expanded across the country yet. It's got a lot of room to grow. What else? A tech stock, as long as you're doing the homework, and the homework shows tech, or at least the part of tech you're investing in, doesn't just be awful. And I've got to tell you something, most people are not willing to do that homework. So that's why I don't recommend a lot of tech stocks. How about an energy stock? I like oil and natural gas, but only if the price is right. Gold stock? Yes. Good hedge against craziness and inflation. I never frown on that. But the most important thing, the bottom line, make sure there is no overlap. If you own 5 stocks or 10, I'll make this very simple. No more than 20% of your portfolio should be in the same sector. That won't always save you from the pain, but it will spread the risk around and reduce your potential downside, making catastrophes less catastrophic.